in particular, and then I'll like go into like some of the Gex stuff as well at the same time. Um, okay, so like what is the net flow model? So like net flow model is like basically a list of like all the stocks that we know like high option volume related stocks, like stocks that like matter in the market maker world basically. And using that concept, like you basically get an idea of like, okay, well, these stocks are the types of stocks that a will like move the market when reviewed, and if you get an idea of like where these like universe of stocks are kind of like moving overall, like in tandem, then you get an idea of like overall like where the market is going to go, like whether it's ES or NQ, right? So like just running through like how to read it, because like I get a bunch of questions on, oh, I don't really understand like how to use this Gex model, like I see stuff but I'm not really like getting it. So just simple like first point is always just like looking at or any indicator that you look at, whether it's even if it's not this stuff, like if you're looking at RSI, you're looking at EMAs, you're looking at moving averages, if you're looking at, I don't know, something weird like Fibonacci's or stuff like that, right? You always want to like just go back and just back test, whether it's visual or like if you're like me, you write some code and then you automate the back test, right? So like here's an example. So if you look at this period here, uh, if you look at this period here, I don't know if you can you see my mouse or no? Probably not.
No. Cannot. Nope.
Oh, okay, all right, fine. I'll just say the dates then, because and it will show on the recording. So when it goes on YouTube, you can take a look at that. But um, looking here as an example, like just before March, like sort of mid-Feb round period, you can see like where we had like a double top in terms of SPY, like from where the price actually went. But then when you look at total net flow, we had two major peaks. Like obviously you can't like look at further back in terms of period, but this was intentional from me, simply because like in terms of like a market regime change, it really kicked off around Jan time, like towards the end of Jan. Um, like prior to that, we were like breadth was horrible in that run up to all time highs. It was actually like disgusting from like August onward for a lot of the other stocks. Like a lot of the COVID favorites like Snow, Zoom, Net, um, Roku, Peloton, Palantir, like those kinds of names, right? Like the ARC names, they were getting slaughtered, but big tech was just ripping non-stop, and like ES and NQ just made you think that, well, actually the market's doing great if you just looked at those futures, right? But if you look at this model, basically what it's telling you is like, okay, when is well, what you're really looking for is like when is positioning extended? Like when is it going too far out either side? So if I look at this as an example, like I look at Feb, I can see there was like an outsized positive positioning here relative to like the last month. Um, that hadn't happened before. Like we had one peak prior where it was positive, and during that period, we then also like sold off. Um, so just using this on its own, let's say you're not looking at anything else, which personally, like I think is always best, like as a first point, like just focus on one thing and then start to incorporate other things, because otherwise you just get information overload and you kind of get lost with stuff. But you see that major peak here, right at the end of Feb, like just before the March period, where that you have that double top, like right at the beginning. That was like a major peak in terms of positioning at that point. With that in mind, then like you would look okay and think, well, actually, like I'm not looking to be super long at at this juncture. Like it doesn't really make sense to be doing that, because all it's saying to you is like, where is everyone else positioning? Because like our models are focused on the participant and then reflected on the market maker side. So if I can see that everyone else is long, I don't want to be long a name, right? It's just the simple concept of that. Like you can use other like outdated or like delayed news feeds that kind of like give that data, but like they're lagging, like you end up like backtrailing a little bit. But with this, like it's pretty much immediate, end of day, like you have the data and you can see where positioning is going whether that's following price or going against price. So in this case, like we had that major peak, and then from there, like we just had a major drawdown. Um, so like looking at that, I'd be like, okay, well, I'm actually not going to try and like take a long here, and then just following this, like let's say you ignore the rest of all of this stuff, like sort of going into March, and we're looking at price, and you can see there's like a minor divot down, but actually if you look at the actual total net flow was drawing down pretty aggressively from that peak. So that was around like a 2 billion drop from positive to like minus 1 billion pretty much in that one day, right? The price didn't really seem to reflect that, like from a movement perspective. You then had a bit of a push up, but positioning was still drawing down. So like looking at that, I'm sitting here and just thinking, well, option market is disagreeing with where price is going right now. I'm not going to try and disagree with where the consensus is kind of going, because also when you think about the mechanics of it and like why it works, is because as people are adding more negative positioning, market makers aren't trading against them, they're trading with them. So they're increasing their sell. If they're selling puts and people are buying all of those puts, then they're going to sell more to like hedge their book to the downside, because all they care about, and I've said this like time and time again, is making a business out of risk premia, i.e. they're literally insurers. That is their job. Like they're selling an insurance policy, you're buying the insurance policy, they need to go and hedge themselves for that insurance policy, right? So like just think of it as an analogy. Someone sells house in or someone sells you like car insurance, right? They need to go and hedge for like the likelihood of your car blowing up. Um, they might go and buy some kind of like risk uh, derivative or something like that to go and like hedge the point when they potentially do need to make a payout. And the same thing like works in this case, except it's more simple. Like if they're selling you a put, they then need to sell as well with you to like hedge their book to make sure that if the position goes further down, they start losing money, the loss in money is actually accounted for by their hedge. So then it's neutral and they're still in profit then, because they're taking the money from the credit that they've generated from selling that option. Um, okay, so like as I was showing like March, you can see positioning was going against price, like when you had that minor peak up, and then you just had a really intense sell. So you can't see it here necessarily like because of the ticks and like how wide they're spread out, but that was essentially like moving from like near enough 450 on SPY down to around four like high 420s, so about 428 sort of number, just below 4300, right? We got to that point and then we had like a reversal. Like, okay, if we look at that major peak that we had like minus 5 billion in terms of positioning, but on the basis of assuming that you didn't have all of this other historical data that you can see looking forward, let's just say it was split to that particular time point, you can see that positioning was actually picking up into that dump. Like prior to the dump, positioning was pushing up, right? As that's happening, you're thinking, okay, well, if price is going down, fine, it might continue to go down a little bit more. Like momentum always drags further forward in situations like that, but eventually it's going to reverse, and that's the concept, right? Like you're trying to move ahead of where everyone else is going when they're following price. So here you can see like then you had a sharp reversal moving back from around like 430 to around 440 from that major negative peak, and you can see positioning really pull up. Like we went all the way back to being positive near enough, right? um, and that happened within days. Like that was a very aggressive move. um, so you can take advantage of that with this kind of model. Like you have an idea of like where the market is, and that then as a result should then give you an idea of like where ES and NQ, like the major futures, are going to move, or SPY and QQQ. Thinking of like another example. All right, so if we look at the the period just after March, like heading into April. So it was like sort of mid March. You can then see the same thing again. So price drew down. We then had like another major peak below, but just before that major peak, we had another like drawdown. Into that drawdown, you had the same thing happen again. Positioning drew down, but as price was reaching that point, it was already picking back up. So then you had like a bit of chop, right? Um, as we had that like major, or that not major move up, but like a bit of a small move up, you then had like another pretty aggressive drawdown. But the drawdown was so aggressive, like we're at what -8 billion at that particular point, which is just insane. Like when you're seeing extremes like that, you're thinking, okay, well, everyone else is positioned for the downside. When positioning so aggressive to one side, it's like short interest, right? It's the same concept. You want to go and take the reverse because any movement against where people are positioning for, automatically market makers are going to buy aggressively when other people start offloading their positions because they're experiencing either data decay or charm decay even, so like the acceleration at which a delta is decaying, um, and then like once again we had like an extreme aggressive move up, and then the same thing happened again, like to the upside. We had a peak in positioning again. Looking at that, like I actually did like provide commentary saying like this is a top, go short, during that point, um, and then like, once again like we just had this aggressive like protracted sell into that, and you can see like just if you look closely, like right at that major peak, you can see like positioning actually started to pull down prior to that move down in price. So the same thing happened again. Like these markets lead price. Is that all making sense? I'll take that as a yes. Um, then another example was July, like another major negative peak. Okay, like this is where like things got a bit messy because you had this continuous like peak positioning below, uh, all throughout kind of May, and during that period we had sell, but it was sort of like stair steppy, so we didn't just go straight down. We had like these moves where you had like a drawdown and then like a slight push up and then a drawdown again and a slight push up and so on, right? But you can expect situations like that when you're basically at like near peak negative positioning, right? So yeah, that's basically like the net flow model. It's just a way of seeing the entire universe without having to look at individual stocks or anything, and then just getting an idea of like, okay, well, where is the total market kind of going at a particular point in time. And this CPI print was a really good example. I actually brought that up during the Hexley space. I was saying, well, like net flow is actually drawing down ahead of that major sell. Like if we're seeing price go up and then we're also seeing positioning go up, it makes sense. They want positioning to go higher. Like people are getting out of puts and the call buyers are still remaining, or alternatively, call buyers are just more aggressive than put buyers at that given point, right? So when we're seeing positioning go down prior to price going down, that's just something to be wary of, especially when the move is pretty aggressive. Like we had a 600 million drawdown in net flow prior to that sell. So there was a sizable amount of positioning like moving in. So like if you took that as like a percentage of like this just total historical view, you can see like you have -5 and then like a near peak of 5 billion as well, right? Like looking at that, I'm looking at this all and just thinking, well, 600 mil is like near enough like 10% or 11 12% rather of like the total positioning. For that to move in like one day, that's an aggressive move. So I'm gonna take my chances and like follow those people as opposed to the others. Make sense? I'll just like open it up to like questions. Going once, going twice, 3 times. Okay.
I'll just toss one out here. So for the current drop here, you'd expect more downside until we reach the negative 5 billion mark or somewhere around that area, correct? Just in terms of larger, as you were saying, universe picture momentum. Would that track for you or?
Yeah. Like you're looking for major extremes. Like when you see that, then that's when like you can really get aggressive with your positioning. Like just before we had that major run up, like we've had so far, peak positioning was already there, and price was going down, but then peak positioning had, like overall like net flow already picked up prior to the day, so it was already like saying the opposite before that happened, and it was an aggressive move up again. Like we were at -5 billion, but then all of a sudden we're now at -2. Like something's
Yep.
off there, right? Like why is positioning going up so aggressively at a point like that when apparently the whole market is ending and we're basically going back down to 3,500? Well, like the option market is disagreeing with you, and as a result, market makers are also disagreeing with you too. And like we know, market maker positioning can move in the billions, like intraday, right? And we're not just talking billions; like they can move like tens to hundreds of billions, like intraday, because they have so much liquidity. So
Yeah.
if they're moving that flow in a low liquidity environment, like it's really unlikely that price is not going to move. Like it matters even more so now than it ever has, because low liquidity environment, like any flow that is even slightly aggressive, and I don't really envy their job at the moment, because like you put like 200 lots on ES and you move price like 4 points, 4 5 points easy. It's not even like hard doing it. Um, so like moving their kind of lots, like you would see like really large protracted moves.
Yeah. All right. Cool. That's kind of what I wanted to hear there. Thank you.
No worries. All right, cool. Just to
Question, sir.
yeah, go for it.
Given the move today, and I assume the screen you're sharing is one you generated right before we got in here. Are you surprised the gamma net flow move isn't more strongly down, or like how do you read that today? Because the move down from price on SPY is much stronger than the move down on the total net flow.
Yeah, so like the positioning move is still fairly aggressive. Like we're down now about another minus 400, 500 million from where we were prior. So whilst it looks like it's small, like from a total move perspective, it's not that small. Like the fact that it hasn't like drawn down massively kind of tells me that there are still buyers that are here that exist, and they're looking to like take the opposite side of the trade. Um, so I mean, like with and then also like just combining it with like narratives. Like if you've got a narrative, the way I kind of see it is like you've got positioning, fine, but then do you have a narrative to kind of follow? Because like markets love narratives, right? Um, and if the narrative is still that inflation is bottoming, it is peaking rather, transitory inflation camp is still there and kicking. Like they still believe that price is not that inflation isn't going to go up further. Then as a result, like the Fed isn't going to be as aggressive in terms of their hiking. Well, then like using that perspective, you could say, well, actually, like looking at this, it's not drawn down like as aggressively as it has done in like prior periods. Uh, with that in mind, I would be thinking, okay, there's potential for a reversal. That being said, I wouldn't have as much confidence in reversal simply because positioning itself didn't move as aggressively. So like if it had reached like a major peak today, then I would have a lot more conviction in it, because I'd say like, well, positioning's too far protracted to the downside, so it's a crowded trade, and whenever trades get crowded, like we know what happens, right? Like you have momentum, fine, but the momentum quickly dries out because the people that were there much earlier with size are pulling out, and it's just like the latecomers that are going to get drowned out again.
Thanks.
So just rephrasing that, you'd say like the put trade isn't crowded yet,
Yeah.
considering where we are in net flows.
Yeah, exactly. And then obviously you can also like compare it to like the sector positioning that we've got, so you can always like look at, okay, well you have like total net flow here, but then fine, like I want to look at big tech as a sector, right? I want to see what they're doing, and then using that, then I would be like, okay, well, if big tech is moving moving up, so let's scroll up. Like big tech is like picking up, then they still agree with that. But if I'm looking at big tech right now, like that's getting near to another peak again. So using that concept, we'll be like, okay, I don't want to be too aggressive with like pushing down now on say the Qs, because I know that big tech as a sector is like nearly a quarter of the entire market cap of the Qs. So if that's a crowded trade, and like we've seen in the past, like how much influence big tech can have on the futures, right? If that's about to reverse, then I'm not looking to take short on that trade further, right? Like it just doesn't make sense to do so. So it's sort of like look at net flow, get an idea of where overall flow is, and then it's like, okay, well, under the hood, what's also happening? Like, where are the big movers of the futures market going? And if you know where they're going, then you also know where positioning is going too. Because you see the same thing here on like big tech, right? Like that same period, 2nd of September, was also the same period where the market maker model had like 25 plus buys on it. When it's stacked to one side, and you're seeing this on big tech sector positioning, you're seeing it on SPY, you're seeing it on Qs, you're seeing it on net flow, like it just doesn't make sense to be short, especially when like the market maker model itself like has backtest results that suggest that, okay, you can have like 1 to 2 day lag between when the buys or sells come in, and then you have like a positive expected return within those 5 days. So from the date of, so with that in mind, like it's sort of like, okay, well, probability is like favoring the trade, and that's all we care about, right? Like we just want to flip a coin and like have the coin flip in our favor enough with enough size. So you could literally like not even, you don't even need to trade like every day. Like using data like this, you could just wait for the right period. The trade can come to you, and then get aggressive with the positioning when it comes. It's just about having the balls to do it. Cool. Well, yeah. I'll cut the recording there. For those of you like listening on YouTube, hopefully that makes more sense with regards to like how to use some of our models. If you haven't already, please do check out vexly.co and give us a try. We hope that we don't disappoint, and hope that some of the results from these models today demonstrate why we are producing data-driven, back-tested models. Cheers.
Did you